Hey everybody, Brian Bogner, Greg Towner here with Parallel Portfolios, and we have an exciting video for you this month. We're going to talk about large cap stocks and just how concentrated they are. Because when we talk about the stock market, everybody says, well, the S&P 500. Well, the S&P 500 are just large cap stocks. You got small caps, mid caps, international, emerging market. You got all these other different groups of stocks, but yet, right, we see this headline, S&P 500, S&P 500, this is the stock market. Well, we're going to pull back the hood a little bit today and just talk to a little bit about what is really going on with it. And what we're saying here is they're concentrated. And let's go ahead and get started. Greg?
Yeah, Brian, it really is amazing if we look back at last year's strong market returns, how much it was concentrated in a handful of names. Particularly the top 5 names all happen to be tech related. Apple and Microsoft and Google and Amazon and Facebook, names that we've pretty much all heard of. They combined make up now 18% of the S&P 500. That's that blue column there. 18%, just 5 names out of 500. It's actually more than back in the tech bubble, back in 99, 2000. Now, fortunately, the yellow column there, the net income has increased as well, but it's still a little bit of a concern, or at least something for us to keep in the back of our mind, that the returns have really been concentrated.
All right.
And this one is where would the actual returns come from? So not so much how much part of the index they are, but what did they contribute to the actual index return. So just 2 names, Apple and Microsoft, contributed 15% of the returns last year. The top 10 names contributed about 30%. So really concentrated. And it's not that we don't like some of these names. We own a lot of them in our individual portfolios. We like a lot of their long-term prospects. But it gets tough when they get concentrated like this. Investors sometimes they try to chase those returns, brings on a lot of risk. And we know, Brian, that things can really change over not too long periods of time. I mean, it was only a little over 10 years ago when ExxonMobil, the energy company, was the largest company in the S&P. And now, if we look at it, Apple all alone is bigger than the entire energy sector. So things can change quickly.
Yeah, and taking that a step further, so why are we talking about this? Why is it important? Because we can pull up a statement or look at an account and go, well, hey, the S&P was up 30% last year. Why is my account up this amount, or things like that. We hear that, of course, from a lot of our clients. Well, let's talk about the S&P, because if all you did was own the S&P and nothing else, then yeah, you've got a lot of exposure to these few companies here that are really driving those returns right now. And so why are we talking about this? Because it's important to be diversified. Okay, now this graph's got a lot going on it, and basically it shows some different asset classes. We got real estate in here, emerging markets, commodities, large cap stocks, small cap stocks. We've got fixed income, cash, things like that. And this goes all the way back to 2005. So this even includes the downturn here in 08 and 09. And the best performing group obviously is on the top. The worst performing group is here on the bottom. In a diversified portfolio, no surprise, right? It's never going to be on the top, but guess what? It's never going to be on the bottom, right? It's going to be right here in the middle. And the best thing to be in last year was large cap stocks, right? Large cap stocks were up 31.5%. But as you go through here and you kind of see, well, small caps were up less, developed market. I mean, most everything was up last year, but it was just a matter of how much. But what's a diversified portfolio up? About 20%, okay? But here is the important thing when you look back over history. A lot of times what is on the top, if you look at 05, 07, 08, you had emerging market up here. Well, guess what happened? Emerging market, spent a few years down at the bottom, okay? Now, I'm not saying, hey, large cap's gonna tank and be the worst performing group, but we're saying things don't typically just stay in that extreme area there. And so we preach diversification because, look at back in 08. In 08, a diversified portfolio, again, if you had no risk management, all you were diversified, set it and forget it, was down 25%. A large cap portfolio, almost 40% down during that time frame. So significant benefits there to diversification. So when we say stocks, when you're looking at the S&P or you're seeing that headline and you're looking at your account, let's have a good perspective on what do I own. I'm diversified. I'm in different asset classes because, you know, it generates, you know, again, if you look here, you've got mostly positive returns. I mean, 08 was a negative, 2011 was flat, right? 15, you're only down 2, and 18, you were down a little bit more. You were down about 6, and that was actually because a lot of the international really pulling that down in 18. Okay, so but in 17, right, international was the best performing sector, right? So again, what did we see? We saw a reversal that next year. Just again, so that's why we want to be in here. This is the place that we want to be invested. We want to be diversified. So if you have any questions, any thoughts or comments, you know where to reach us. Give us a call, shoot us an email, and thanks so much for listening today.